Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Northrop Grumman stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Northrop Grumman is an aerospace and defense technology company. Its headquarters are in Falls Church, Virginia, and was founded in 1994. It was formed from the merger of Northrop Corp., which was founded in 1930, and Grumman Corp., which was founded in 1939. It went public in 1984 and currently trades on the New York Stock Exchange. It is one of the world's largest weapons manufacturers and military technology providers. Northrop has won the Kalia Trophy 8 times, most recently for developing the X-47B, the first unmanned autonomous aircraft. It's currently in the lead for the development of the B-21 Raider, a long-range stealth strategic bomber that can drop conventional and nuclear weapons. Sometime this year, the company plans to launch the James Webb Space Telescope, an orbiting observatory. It was the sole bidder on the Air Force's Ground-Based Strategic Deterrent Program to develop and build an intercontinental ballistic missile. Let's get started with the model. This is a large cap company, 50 billion market cap. They're trading at $2.99 a share and they have 167 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive and growing free cash flow, up to almost $3 billion in 2020. Net income is the profit and loss on the income statement. That's revenue minus expenses. That goes from $2 billion to $3 billion, back down to $2.2 billion, up to $3.2 billion. Revenue is the sales for the company, and that grows each year from $25 billion to $37 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit, and that's growing each year up to $7.5 billion. Below that is operating expenses. Then below that is operating income. When you look at the income statement, you should focus on operating income because the stuff below that is not part of their operational business. Below operating income is the interest they pay in their debt, and that's up to almost $600 million. Below that is other income and expenses. Then you have your pre-tax income, then your taxes. And the bottom line of the income statement is their net income. That was highest in 2018 and 2020. You can see operating income is bigger in 2019 than 2018. The reason net income is lower in 2019 is because of this other income and expenses of negative $900 million. They had a positive $500 million in 2018. That's why their net income is so much lower in 2019 when compared to 2018. This is the company's statement of cash flows. The top line is operating cash flow. I like to focus on operating cash flow when looking at a company. I think that's more relevant than net income. Operating cash flow is how much cash the company generates from its operational business. That peaked in 2020 at $4.3 billion. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Free cash flow is the cash that's remaining to pay a dividend. They pay about $1 billion of dividends. It's also the cash that's remaining to pay down debt, to buy back stock, or to invest back into your business to grow it. The company buys back a lot of stock, $400 million in 2017, $1.3 billion, $700 million, then $500 million. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They also issued a lot of debt in 2017, over $8 billion. When a company with positive free cash flow issues a lot of debt, it's usually to acquire another business. They paid down $2.6 billion in 2018. They paid down $500 million in 2019, but they issued more than $1 billion in 2020. Let's look at the capital structure. $11 billion of equity, $16 billion of debt. They're 40% equity, 60% debt. Their net debt is $11 billion. Their WACC is 7.1%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $89 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $80 billion. We divide that by 167 million shares. And we get a calculated stock price of $4.77. They're trading at $2.99, so they're trading at a 37% discount. It's a strong buy according to the model. Simply Wall Street values the company at $3.81. They're also saying the stock is undervalued, just not as much as me. This is the stock price the last 5 years. It looks like the stock might have peaked about 6 to 8 months ago, around 360, 370. But now it's sitting at 302, so it's sitting at a nice discount relative to its all-time high, also relative to my model and Simply Wall Street. This company seems to raise its dividend each year. It was 90 cents back in 2016, now it's $1.45. They pay about 2% in dividends. And the way you calculate that, you could multiply the last dividend payment by 4, take that number, and divide by the stock price. They pay out 30% of their net income and 34% of their free cash flow. They have a pretty low beta, 0.78, so the stock moves less than the market. The stock has gone down 14% in the past 52 weeks, while the S&P 500 went up 24%. The 52-week low was 263, the high was 357. And the stock is trading above its 50-day, but below its 200-day moving average. When the 200-day moving average crosses above the 50-day moving average, that's called the death cross. That's a bearish signal. About 1 to 1.3 million shares are traded each day on this stock. Almost all the shares outstanding are on float. 84% are held by institutions, and more than 5% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you'd be really happy because you'd be over $60,000 today. That's an annual return of 20%. The biggest shareholder is Capital Research at 12%, then State Street, Vanguard, BlackRock, and Wellington. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 15.6, so investors are paying about $16 for $1 of earnings. Price to sales is stock price over sales per share. They have a really good price to sales ratio at 1.4. Price to book is stock price over book value per share. They're at 4.7. They also have a good price to book ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $11 billion of equity, negative $8 billion of tangible equity because they have $18 billion of intangible assets on their balance sheet. A company gets intangible assets on its balance sheet when they acquire or merge with another company. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 7 times. ROE is net income over equity. They have a great ROE at 30%. Current ratio is current assets over current liabilities. They're at 1.6. They have a great current ratio. And their current assets are $5 billion of cash, $7 billion of receivables, and $800 million of inventory. So the company is really well capitalized. They had almost $3 billion of free cash flow, $6 billion of working capital, and a $1 billion dividend payment. So they have $7.7 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 19 companies in the same industry as NOC, and if NOC has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are worse than average because the average is really skewed with these big negatives. But 15.6 is a good PE ratio. They're doing much better than average in price to sales and price to book. They're doing fine in current ratio. They have a great ROE, one of the best on the list. They're higher in debt than the average at 60%. They're a really big company, 50 billion market cap. The average is 38 billion. And they pay a higher than average dividend. So to summarize, I have them trading at a 37% discount. This is a really big company that's very important to the US government. So there's no risk of this company going away. This is a good long-term hold. It's only going to go up over time. Some of the products they build, even their competitors have a hard time building. They do something really specialized within their field. Plus, their predecessor companies have been around almost 100 years, so they have a really long history. I rank their free cash flow 6 out of 10, their revenue 8 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.